to the comment section as well. Tonight is all about you. I'm going to be answering your questions. So exactly where you've been putting no sound in the comment section, throw in your comments there, and I'm going to answer all your questions. I'm here for at least an hour. If we need to go over, I don't mind. I'm really enjoying the live stream, and I'm happy to get it running again. And so tonight, the focus is on you. And so anything, retirement planning, financial planning, how to invest money in today's environment. If you have life insurance questions, if you have questions around, withdrawal strategies or CPP, whatever that is, the whole umbrella of holistic planning, I'm yours for this evening. What I'm going to start off by saying is I have one question that was emailed in, so I'm going to begin with that one. And I kind of, you saw that in the beginning, but I'm going to put that back up so you can hear my answer. So here it is. So I'm in a high tax bracket. Does this make sense for me to make to do a TFSA withdrawal of $25,000 and then deposit that to my RSP, take the $10,000 refund and put that back into my TFSA? Does that make sense? And are there any drawbacks? And Trent, thanks so much for your question. So Trent, you're right on schedule in terms of doing that strategy. Is an excellent strategy. So you take the TFSA, do the withdrawal, put it into your RSP, get the contribution, get the return, and then putting it back in your TFSA. I wouldn't do that way. Just a little twist. I would take the refund and put it back into your RSP. RSP contribution strategy is 2 steps. The first is you are making a contribution to your RSP. Theoretically, I mean, the strategy is you're trying to save for the future, but what the contribution does is it lowers your tax for that given year. And so you get this tax break, and that money comes to you and you're like, great, I got this tax refund. What a lot of people do is they'll pay down a debt, or they'll go on vacation, or they'll purchase something. What you ought to be doing is reinvesting that refund back into your RSP. So I would say to you, good strategy. The twist is put the money, the refund back into your RSP. You'll see your RSP will grow much bigger. Now, on the subject of RSP balances, I have a video that I'll be posting tomorrow morning, that will be talking about how much money you actually need in order to retire. So there's 2 parts of tomorrow's video that I think 10:45 in the morning it posts, and that is what is not enough money to retire on. So I give you 2 things. What appears to be a large sum of money, but how long does that last? So specifically, how long does $500,000 last in retirement as compared to, say, $800,000? And so that you're going to find that video is going to be very useful for you to see live, going through the financial planning software, how the withdrawal on a minimum RIF schedule, how long $500,000 lasts as compared to $800,000. So tune in tomorrow morning at 10:45 and you'll see that video. So that is, I hope that answers you, Trevor. It's a great question, but you ought to be just doing it slightly different. So I'm just going to go through to see if I have some questions. And don't be shy about putting your questions in the comments, whether you're on Facebook, LinkedIn, or YouTube. Put your comments in there in the stream, and I'm going to be able to see that comment and then go ahead and answer your question. A little bit about what's been going on with me over the past year and a half, 2 years of doing YouTube videos. My channel has gone extremely well. I'm so excited. Over 10,000 subscribers now. It's something that I didn't expect that was going to blow up so rapidly, and I'm grateful because prior to doing YouTube, I was doing a lot of speaking. I was being invited to do a lot of speaking to the CGAs, CPAs of Ontario. And so I really enjoy teaching and educating and getting in front of people. So this was an awesome medium for me to just dig into. Okay, let me just see some more questions here. An RSP meltdown. So Alim, you have this question. I'm going to put this up on the screen. Can you discuss the strategy of an RSP meltdown? Great question, Alim. And so let's go into that. I have some slides on that very, very example, I believe. And let me just see if I can. No, I don't have the slide. So I'll explain it to you. Well, here, have a look at this here. And this kind of goes into this idea of what I talked about in the video tomorrow. And then this will answer Liam's question. When you are investing in an RSP, the danger of growing your RSP too high, so to a high balance, and also you have to be aware of, as a couple, between the two couples, when one has a much larger RSP balance than the other spouse. This is a good example. This was actually in one of the videos. So in this example, the person grows their RSP to about $900,000 at age 65 and then chooses to retire and converts their RSP into a RIF. That, you see the blue area, how it's sliding down and goes out to age 90. What that represents is a minimum withdrawal schedule on a RIF. And they only consume roughly half of their RIF balance over that period of time with a minimum withdrawal. And that's because, as set out in the guidelines of your withdrawal schedule, how much you have to withdraw each year. So at age 65, it's 4%, and it just goes up. It gradually goes higher and higher, that withdrawal rate. But it's still not significantly higher than, let's say, your return. So what ends up happening is that $400,000 that you see there, the 406, let's say on the last death of a person, that would be put into your final tax return, and you'd have to pay tax on that. So you'd lose about half of that money to taxes and CRA. So it's really important that you be aware of, it's not just enough to have money go into an RSP, but you have to be thinking about how much is enough and what other types of accounts you ought to be investing in to diversify that income stream. So when we see people that have high balances, and depending on the timeline of when they retire, we might start thinking about an RSP meltdown. So let's look at this timeline here. This is a really good illustration. You may have seen this in some of my videos, and we'll just go through it really quickly, left to right. So the earliest time to take CPP is age 60. Everyone knows that. And then, but that is at a permanently reduced CPP income to you. When you are 65, it's 100%. And of course, you can defer all the way out to age 70. And the last year in which you can convert your RSP to a RIF is at age 71. And then you could even push the income stream until a month before your 72nd birthday. So yeah, a little bit of that timeline. So, but what would happen if you were retiring, say, at 58, 59, and it was before age 60, and let's say you weren't planning on taking any money from your CPP until age 65. So here's the advantage of an RSP meltdown. You've got too much money in your RSP, and you might have other income sources like a pension plan that you can rely on. You might have a large tax-free savings account. You might even have other income streams like rental property coming in. And so you don't really need, things change. You don't really need the RSP, but if you just simply left it as a minimum withdrawal schedule, you would just not use up all your RSP. So what you want to do is you want to be able to do withdrawals in your RSP each year until such time as you've either melted that balance down. And the way you get to do that is you work with an advisor. They do a plan, like I do plans for all my clients. And we look at two things when we're taking withdrawals out of your RSP. How much increase of taxation are you going to experience? So if your income is relatively low, we'll say, we can take money, let's say, depending on your balance, we could take withdrawals right up to $53,000, $54,000 before you go into the next tax bracket. The first marginal tax bracket is 20.5%. So if you wanted to take money within that, before that tax bracket goes to the 24% marginal tax rate, then we could just simply monitor how much taxes, what's the increase to you. So let's say you had $30,000 income, and we're going to take an additional $20,000 or $21,000 from your RSP, and just do that every single year. And then we're simultaneously monitoring how much of an RSP balance that you have, that you're still going to have an income stream in your late 80s, that you'll still be able to have that money paying out to you. So we're trying to lower the balance so you don't end up leaving too much behind. Now, we don't know when we're going to pass away, but if we just took average mortality rates in Canada, we're looking at in Canada about 85 is the average age of death, and for men it's around 81. So if we did a plan that at least went out to 85 or 90, male or female, we want to make sure that your RSP balance is not going to be, if that's the only thing you've got. If you've got other investments like non-registered tax-free savings account and other income streams, then we could expire that RSP much, much earlier and not have you have any RSP when you're in your 80s and 90s. We could just use up that right away. So every strategy is different for an RSP meltdown. Now, there are two ways, Aleem, I hope that answered your question around RSPs. If I did, you can just give me a thumbs up. But there are two ways to do an RSP meltdown. Now, the one that I described was just simply doing RSP withdrawals. The second way to do that is using leverage. And I'm not in favor of using leverage. I have done it for clients before in the past, but you're talking about borrowing money in a non-registered portfolio. So you've got your RSP, right? And you're going to borrow money to the extent that, because of when you're borrowing money and you're reinvesting that money into an investment portfolio. So let's just take $100,000 you borrow, you take that $100,000, you invest it into the stock market. Doesn't matter how, if you put it into a segregated fund, mutual fund, a stock portfolio, bond portfolio, doesn't matter. You're putting into the market. That investment becomes tax deductible in your non-registered account. Now, this works better if you're in a high tax bracket. If you're in a lower tax bracket, not the best thing for you to do leverage in a RSP meltdown. But when you take that money and you invest it, you're going to get you get to write off the tax to borrow that money. So whatever that cost to you is for that year of borrowing, you want to do a withdrawal that the tax that you would pay on the additional RSP withdrawal is equal to the tax break that you're getting on the loan that you're getting. So the two sort of cancel each other out. And this is a long-term schedule. You're looking at probably 8 or 10 years of doing that, trying to melt down your RSP. Now, the danger with doing the second way, using leverage, is the stock market. I don't know if I've got a slide here. Yeah, let's do this. Yeah, I'll show you this slide. Is the stock market. This is live. This isn't make believe. This is the S&P TSX. That's your Toronto stock market, 1997 to 2023, and you've got these pretty colossal collapses in the market. You know, like, look at it. It's like the tooth of a saw. You can imagine that someone who is using leverage in this case, seeing their portfolio drop by 30 or 40% is a very unnerving thing, trying to save money on taxes. So this is what you have to endure. You have to have a high risk tolerance. You got to make sure when you're using leverage to do an RSP meltdown that this is not the only investment tool you've got for retirement. Because if things go south and they go poorly, and I've seen this, I've done portfolio reviews. People send me their portfolio and ask me, what do we do? And they're down 40% and they can't get out of this loan that they did. Someone convinced them to use leverage to do the RSP meltdown. And now they can't get out from this because now they owe $40,000. And absolutely the wrong strategy. So I would not encourage you, if you're just like a regular person, not high net worth with lots of money and lots of assets, I would not use the leverage. So thanks again for your question, Elaine. Good question. I got another question here. And by the way, everybody who's been subscribing to my channel, I want to just say real quickly, thank you so much for all of your support. Getting over the 10,000 subscriber mark is just blowing my mind. I'm so deeply grateful, and I can't wait to continue to put more videos out for you. My intention is to go live every Wednesday if I can, and I'll be notifying everybody that I'll be going live each week. let me ask, there's a question here. I'm just going to read it here. It's a long question. Okay. I'm gonna put this question up, a little bit harder to answer because I don't know much about you. But let's read this together. Last night, I asked my advisor what I should do after I max out my RSP room and my TFSA room. He blew off the question, what would you suggest $50,000 investment annual? Okay, great question. So in a vacuum of not knowing you, and it doesn't say the names, it just says private person, obviously. So, you know, there are other investment opportunities for you to do. And I have to be careful how I answer this because I'm not a mortgage broker. I'm not a licensed mortgage broker. So, but I could just simply rhyme off different investments without saying to you, you ought to do this. But you could do with $50,000, you could be doing private lending. You could give that money to a mortgage company that give out private loans. People are somewhat skeptical of this. I have clients that actually do this, and they make really good returns. I would say better than what they're making in the market. And I have to say that, in all honesty, I hope you appreciate the transparency and the directness and honesty that I deliver these answers. You can get consistently really good returns that are outpacing the Toronto stock market return. Right now, the Toronto stock market, the S&P TSX is negative year to date. Whereas in a mortgage, it's quite likely you would be beating that pretty easily. So that's one area. A non-registered portfolio and putting that into different investments, I would say, have a completely different alternative investment style. The other thing too is, you know, this idea that your advisor is blowing you off really is upsetting to me because I take this job very seriously and with a great sense of pride. And when people take time out of the day to call me or email me a question or even just send me their portfolio, it means they're asking for help. They're putting their hand up and they're asking for help. And to simply just say, that's not important to me. I have a lot of gratitude for people and also sympathy for people who are trying to figure out how to save money for their future. And it also involves, when I give them great advice, their entire family benefits from that advice. So I would say to you, I just don't like the idea that your advisor is blowing you off. Now, I would go back to my days of when I worked at Nesbitt Burns when I was a young guy, younger than I am now. And I was learning under one of their best brokers who retired at the age of 29. So I give you some insight of how well they were doing. And his job was, and I'm not disrespecting him, because if Derek is watching this, he'll know exactly what I'm talking about. And that is the job of, there are two different kinds of advisors. One is someone whose job is to multiply the money that you give them. And the other one, and that first one doesn't care about your lifestyle, doesn't care about holistic planning, is not interested in the vacation you want to take. Their only job is to multiply that check that you put on their desk. That is it, hands down. So if he's blowing you off, I'm kind of curious about that, because you're saying you got another $50,000 and what should I do with this money? He should be saying, I know exactly where to put that money if his job is to invest money. So I don't like that question, that reaction. Then the other advisor does holistic planning. So you're going to see holistic planning is holistic planning. You see that all the financial institutions are claiming to do holistic planning. But if you are not life licensed and you're not doing financial plans, not doing retirement plans, not doing estate plans, then that's not holistic planning. You need to find an advisor who can actually do all of those things. And so a typical way that a bank or a brokerage firm deals with that situation is, you have this relationship with the advisor that maybe you really like that advisor and they're giving you great guidance on your money, but they don't do any planning. And when you want planning, so I've said in the videos, most people have a contribution strategy and haven't developed a withdrawal strategy. They really don't have a withdrawal strategy for you, because their job is to multiply money. So their strategy is to to reach out to another department where they will bring in two different people that will do estate planning and retirement planning for you. So you're developing a new relationship with these two advisors. And typically brokers and advisors don't like that too much, because what it does mean is that if that part of their department says you ought to use life insurance, we should start depositing that $50,000 into whole life insurance, then that means you're taking money away from that advisor to do that. And that advisor is not going to be happy about that. So I would say to you, so long story short, you could put the money into a non-registered portfolio. You could start lending it out through private mortgages. You want to contact a mortgage broker that does MIC mortgages. MIC is the acronym. You could invest it in life insurance. So I'm saving the last part to the end. You could put it into life insurance if that fit. And the way that I help my clients, I'm life insurance licensed right across most provinces, actually. The way that works is we do a financial plan. So if you're with an advisor the right way, if they're doing things properly, they lead with a financial plan. They say, before you make a planning decision, let's make a financial plan and see what that planning decision, what that would actually do. What's the outcome? What's the benefit? And then every time you make a significant financial decision, you have it put in a financial plan, and you look at the outcome, and you balance that against other different investment choices that you could be making. So when people say to me, should I be using life insurance? I say, well, let's find out. And we put that into the plan. We look at how much cash you should deposit over a certain period of time. And then if you're thinking of using that money, collateralizing that money later on, if anybody wants me to dig into that tonight, let me know, and I'll show you a very quick version of how you can use life insurance to supplement your retirement. If you were to deposit that money into an insurance and then use that money later on as a tax-free income source, that might be something you could do with your $50,000 every year, or part of it. The question is, though, are you healthy, and what is your goals for your estate, and so on. So I would say there's a lot you could be examining. It's just a question of understanding who you are and what your goals are first. And I got to tell you, if I have a client that's saying to me, I got another $50,000 I want to invest, it's my job. My job is to say, okay, let's talk about what we can do with that. Lots of questions here, guys, and thanks so much for your questions. And how are we doing? If you like what we're talking about so far, give me a thumbs up, share the video with everybody. I appreciate all your questions. Let me dig into some more questions here. Okay, this I love. Jeff, I'm going to share this question with everybody because I think it's important. I need water. Went for a 4.5 kilometer walk before I started this in today's weather, so to relax before the live stream. How important is it to have a tax-free savings account? Well, first, Jeff, watch the video tomorrow that drops on YouTube at 10:45 in the morning, because I talk about the importance and where a tax-free savings account fits into your retirement planning, especially for your withdrawal strategy. We're putting together our savings into renovating our house, which will increase in value when we sell, and the profit will also be tax-free. Thanks. Got it. Okay. So great question, because you're really talking about this advantage of having, flipping your home at some point. You're going to have a tax-free gain in your home, which is true. Now, let me just start to explain briefly, what is the importance of a tax-free savings account? Where is it used inside of your plan when you're doing retirement? I just talked about making contributions to an RSP. It's the most widely used tool for investing in RSP. It's a tax-efficient product, but not the best product for everybody. So you have to really examine which product is the best for you, and you just have an open conversation with your advisor about that. So a tax-free savings account, I want you to think about, I'm just going to see if I've got a slide on this, because I might have, no, I don't. Okay. When you look at an RSP and a tax-free savings account, you look at how you're going to receive money in retirement. and you say, well, my need is $70,000 a year, $100,000 a year, whatever that number is, I need that amount of money in our pocket every year so that we can travel, we can keep the lights on, groceries, gas in the car, whatever, all that is inside of your need. You establish that, and then you say, okay, from where is that money going to come from? Which accounts are we going to withdraw money out of? And which will come out first? And what are the amounts that come out of those accounts? So do we take money from a non-registered account if you've got money in your non-registered? Do you take RSP first? Do you take tax-free savings account first? So you have those three accounts, and you go, which one of these do I withdraw money from? And you look at that from the first day that you're retired until 95, whatever age you want to go to. And you can, in a financial plan, which I do for clients, we can change those priorities every year. We can go RSP first or tax-free savings account the next year. It's up to us to figure that out. A tax-free savings account is very, very useful. And the reason for that is if you don't have an RSP, and Jeff, you got to look at this video tomorrow because it talks about having only one account. And I think the one that went yesterday also talked about, actually the one yesterday on my YouTube channel talked about having only one investment account, and that's the RSP. If you only have one investment account like an RSP and you don't have a tax-free savings account, then when you go to withdraw money because you need that for your retirement, you're having to force yourself to take out money out of one account. And when I do plans, I can share this part with you. This will be good. When I do a plan, very often people will say to me, in the questionnaire that I give them, I said, I need to know not all, but all of the significant expenditures that you're going to have throughout your retirement. So people often think, well, I need $50,000 or $70,000 for a home. And I say, you know what, how often do you replace your car in retirement? So people say, well, probably have to buy a new car. Well, if you're retiring at 65 and you're driving till at least 80, you might have to replace your car twice, maybe 3 times, depending on how often you think you need, or how new the vehicle is. So you might be having to decide to help your kids to get married and pay for that wedding expense. So how do you fund that? Do you draw down, put money into a side account, and you do that every year and we show that in your plan? Or is it just one withdrawal comes out that one year? And how do we accommodate that? Education needs for your kids, traveling, house maintenance. I guarantee you that you are going to be doing house maintenance from age 65 or age 60 to 95. You're going to be doing something to your house. You're going to change the kitchen. You might need to put in a ramp because it's easier to get up into your house. You might want to put a bedroom on the main floor so you don't have to go up the stairs. Putting in like all kinds of different handicap bars and like so many things. You might just want to replace the floor. Lots of things. People will say, I want to live abroad for 3 months, 4 months. Add that into my plan. And then what about just gifts to the kids? All of that goes into, and that's just like some of the titles. Everybody that I do plans, I'm always surprised by having a new column and say, that's a new one. Let's talk about how we're going to fund that expense. A tax-free savings account is going to save you thousands of dollars. And the reason for that, imagine or consider this, you're 2 years into retirement, you're doing your RSP with RIF minimum or whatever amount you're taking out. And then something comes up where you've got to have a much larger expense that year. Instead of it being 70,000, it was 140,000. Okay, roof broke, furnace broke, like things went south for you that time. Or maybe it was an opportunity. Let's not talk that it was a bad news. So if all you have is an RSP account, there are only 2 options for you. One, you're going to take a line of credit against your home and go into debt to fund it, and that's not good in retirement. And the second is you're going to increase your withdrawal on your RSP. And when that happens, you're going to pay a lot of tax to do that withdrawal. So this is where your tax-free savings account comes in handy. Consider that you've got $200,000, $300,000 in a tax-free savings account, and you need additional income that year. Well, you could just simply draw that from your tax-free savings account, fund that surprise expense and then back to regular RSP withdrawals. So the purpose of a tax-free savings account is to integrate that into your withdrawal strategy, so you're not increasing your overall tax that year. And also it extends the life of your RSP. If you don't have a large RSP balance, like in tomorrow's video, you're going to see that you might need a tax-free savings account to allow you to do a minimum withdrawal and then use your tax-free savings account to supplement the extra that you need each year. But great question. Okay, let's go on to the next question. So there's one question about, thanks very much for the good vibes coming from you about doing great videos. I put a lot of effort into these videos. I'm a very analytical person, and I like to make things perfect when I do videos. And so when you ask me a question, I have all these drop-down menus going through my head, and I want to be able to say, well, to answer that question, I got to go through these 4 or 5 different points. So that's why my videos tend to go along, and I've been trying to just say, okay, let's just talk about the most important bullet point, and we'll leave the other ones to the side. So I'm trying to keep these videos shorter. So I appreciate your comment. You're retiring in 3 to 5 years, and you're going to have a pension plan, 20 years of service. Are you doing financial planning regardless? Yeah, I do financial plans. Right now, I'm licensed in Vancouver, Alberta, Manitoba, Ontario, New Brunswick, Nova Scotia. I'm not licensed in Quebec. I'm licensed to do, let me put it a different way. I'm licensed to do financial plans in every province. What is important that you should understand about licensing, and that's why when you, maybe I'll take a minute just to talk about where do you get your advice. When you go to speak to someone about an idea for investing, they can only answer that question in the scope of what they're licensed in that question. So if you asked a question at a bank about the merits of life insurance, should you invest in life insurance, and that person's not life licensed, they can't talk to you about it because they're not life licensed. And worse yet, if you got advice from them and they didn't know what they're talking about, then it's an absolute disservice to you. To do a financial plan, you don't need to be licensed across Canada to do a financial plan. The only time the licensing becomes an issue is where I'm actually giving you advice about how to manage your money or how to use life insurance. And that's where those 2 licenses need to be in the province where you're residing. And so I have license to obviously manage money in the provinces I've just listed, and also in the province and life insurance in all those provinces. I'm not licensed to manage money or life insurance in the province of Quebec. I'd have to rewrite an entire exam over again. And because Quebec follows the laws of France, it's a completely different licensing and I just have, I just decided, not anything to do with French. I'm French Canadian. My mother is from Quebec. I just decided, what, with all these provinces, I've got enough ground to cover. So I can do financial plans in any province. Okay, I love this question. This question is, does it make sense to do a HELOC before you retire for renovations, etc.? So the question is, does it make sense for you to establish a home equity line of credit before you retire? Because once you are retired, they're not really, you don't have an income per se like you did before. Your income is it's likely substantially lower than what your income was when you were retired. So does it make sense for you to establish a line of credit ahead of time? Absolutely. I would make sure that you have a line of credit, even if it's zero, have a line of credit available to you so that you're taking advantage. So when financial planning 101, when you look at how do you fund an opportunity or a problem, and where would that money come from? So if the answer is we don't have any short-term savings set aside for any problems that arise, like you got to fix a car, you have a roof that leaks, or anything else like that, you need to have money set aside for those emergencies. So we call it an emergency fund. A way around that is to have a line of credit that you could tap into throughout your retirement. So that would be a very useful thing for you to do. Now, am I in favor of you using your line of credit to do renovations while you're retired? Doesn't bother me at all. As long as you have the money, the cash flow to service the debt, I have no problem with that, especially if that renovation is going to increase the value of your home. Now, if you're doing a line of credit because you want to change, I'm not trying to belittle the question, but if you're doing a line of credit because you want to change the fixtures in your home, no, who does a line of credit for that? But if if let's say you want expensive fixtures, then that's probably not going to increase the value of your home all that much. But if you wanted to finish the basement or put it in an office, we saw the value of homes that had offices during COVID where people could come back to their home. That was one of the biggest things for contractors, was changing the home around so that people could come back to their house and work. I'm grateful that I have an office behind me here. Those two double doors that you're looking at, that's a closet, by the way. That's not the door to my office. But I have an office here that is, it's probably about 16 by 16. It's quite a large office. So I've been grateful that COVID is not an issue for me, and I can work out of this office pretty easily. But I would absolutely have a line of credit going into retirement. That is something that you'll be able to use to take advantage of any opportunities, or certainly help you for any sudden expenses that you might have. For the private person that asked me the question about financial planning, you're welcome. I appreciate your question. Wow. Prithia, thanks for your question. How do I feel about whole life insurance? That is like asking a dentist, how does he feel about drilling your teeth? And I'm having fun with that question because I'm life insurance licensed. I've been doing life insurance since not from the very beginning. When I started at Nesbitt Burns, learning the business, I wasn't licensed. I believed that I wanted to just be a broker, and I went to work at Nesbitt Burns. I had a bit of an ego back then, and then I saw what holistic planning was all about, and I got my life license and went and worked for an insurance company for a long time. Now I'm an independent advisor, and I'm life licensed, so I can purchase life insurance from any company, so I'm not beholden to one company. So you're talking to somebody who's been doing life insurance now for 22 years. What do I think about whole life insurance? Well, I'm trying to cap my enthusiasm here. I think life insurance is by far one of the single most important retirement tools you could ever invest in, if you have the cash flow for it. And that's the big caveat here. So you're going to get a lot of people who are going to argue that, and I don't mind that argument. They'll say real estate's the best thing. Yeah, you know what? Real estate for a long time has been the place to be. But some people aren't built to be real estate investors, not built to be a landlord. They don't have the temperament for it, or the interest or the desire to be a landlord. Or they might not have the cash flow to get into that. Everything has to be measured of who you are. Life insurance may not be for everyone as well, because it's slow and it's steady. It's not exciting. There's no ups and downs the way you have in the stock market. We can get excited about the NASDAQ going up 40% in 1 year, and then sliding down 30% the next year, and then going up 40% the following year. That's been the last 3 years in the NASDAQ. NASDAQ is heavily weighted in technology. So the action in the stock market is very, very compelling and addictive for a lot of people who are like day trading or just trading in general, and trying to get bigger returns. But life insurance and whole life insurance it's the difference between the tortoise and the hare, right? Life insurance whole life grows at a fairly, and I say this very carefully, fairly predictable rate. When my first whole life insurance contract was 20 years ago. Shout out to John. Congrats, by the way, John. Where we did whole life, and it was a pretty decent premium, pretty good, sizable premium. and that client is benefiting from it. Now, I will say this, 20 years ago, the dividend was 8%, and now it's 6% and went down to 5% even over that period of time. And now it's going on the way back up. I made a video saying that now is the time, the case to actually invest in life insurance, because we're seeing that the dividend yields are now coming back up with whole life. So I believe that it's a very important tool. The only issue with whole life insurance is it's like getting a mortgage. It only works if you keep paying for it. The moment that you stop paying for your mortgage, the bank starts calling saying, we're going to take your home away from you. Life insurance is the same way. The moment you stop paying for your life insurance, they're going to call you and say, look, we got a problem here. You're either going to have to start using some of your cash value to fund the premiums that you're not paying, or you're going to have to start paying for it, because eventually what will happen is that cash value that you've accumulated over time is going to go down to zero. Because when you don't pay your life insurance premiums, without getting too complicated, the cash value that you've accumulated in your whole life policy will actually pay for that year's premium, so that you don't have to, and then you just go into debt basically for that year's premium, and then you can pay that back anytime you like. But eventually what happens, if you stop paying for it, your cash value will go to zero, and then they'll terminate your whole life policy. If you pay into a whole life policy for enough time, say 7 years, 8 years, 9 years, there will likely be, every company is slightly different, but there will likely be enough cash value and enough annual dividend going into your policy that it'll support the policy for the rest of your life. So you wouldn't have to make any more payments. Even if you couldn't make any more payments, it will continue to fund itself and stay in place for the rest of your life, meaning that you would have permanent life insurance protection until you pass away. So that's what I like about whole life insurance, is that if you can afford the premium payments for whole life insurance, it is a permanent, that's why they call it permanent life insurance as well. It is a permanent protection against your life for all your life. And then once you pass away, that money is available for, depending on how much money is there, it could be just for final needs like funeral, or could be to pay down taxes, or to fund children and legacy goals, and so on. So I really believe in whole life, because when you stack whole life against the S&P 500, the S&P TSX, year over year, the S&P 500 is going to hands down beat the growth of your whole life insurance policy every single year. Well, not every year. There's going to be negative years in S&P 500, but it's going to have an average return that is going to exceed the return of the growth of your life insurance. Where things get dramatically different for whole life, and that is on death and how you use the cash value later on in life. The death benefit on life insurance is going to beat any life insurance. I'll just give you this slide here, and this is going to make everybody really upset about why they're not using whole life. So here's, on the left side is a non-registered investment, and on the right side is whole life insurance. So I'm going to go through this in 2 minutes, so bear with me. On the left-hand side, you're going to deposit $1,000 a month for 20 years. It's $240,000 over the 20-year period. It goes into a non-registered investment portfolio that gets 7%. So I'm giving you all the underlying things here, but you are taxed on the growth of that investment. When you go to retire, and let's say you wanted to use that money over a 15-year period in your retirement. So you go to retire, you're going to take that money out, and over a 15-year period, you're going to withdraw after tax $490,000. That's on the left-hand side. And then the person passes away, let's say at age 86, average age in Canada. And nothing, zero, goes to your beneficiary. So you actually consume that money in your lifetime. Go to the right-hand side of the page. Same dollar amount going in, $1,000 a month into a whole life or permanent life. It's the same thing. Over a 20-year period, $240,000. The growth that you experience inside, so your cash value and the dividend that you receive inside of your life insurance, is not taxed. It's non-taxable. You don't report that to Revenue Canada. Then you go to retire and you want to take that money out. You don't have to do this in retirement, but we're just saying, let's say you are retired. you're going to take $550,000 out of, you're not actually withdrawing that money out of the life insurance. You are taking a loan against the cash value. So you're collateralizing it the same way that you would collateralize a rental property. The cash value has gone up the same way cash value goes up in your equity of your rental property, and you're just going to collateralize it. So you're taking that money via a loan from the bank, and that means that that's non-taxable. When you take a loan from the bank and put that money in your pocket, you don't pay income tax on it. So two things are happening simultaneously. You're taking the loan, but the cash value and the dividend of your policy are still growing the cash value. And you use this money, $550,000, non-taxable to you any way you like in your retirement, and you pass away, same age as in the example on the left, at age 86, we'll say, and $1.3 million goes to your beneficiary. Now you tell me, if that's the way life insurance works, head to head with a non-registered investment portfolio, why wouldn't you use life insurance? That is a 2-minute lesson on all of the nonsense that you're going to hear about advisors who are non-licensed, life licensed, say, or if you watch YouTube videos out of the United States and they'll say, do not use life insurance to grow your wealth and to invest in, because in the United States, you pay tax on the growth of your life insurance, and they have death tax in the United States. In Canada, you don't pay tax on life insurance when it pays out. So head to head, long-term, whole life insurance is going to kick the butt of any investment portfolio, unless you are trading some pretty aggressive stocks, like being in the NASDAQ, exclusively high risk in the NASDAQ. That's a different matter, but whole life is going to wipe out any investment portfolio. So that's I could talk all night about it, but I don't want to bore you. But great question. Love that question. I don't know, Bob, if I'm answering this question right. Talking about retiring poor on paper, just wondering if you come out across people with, I'm not sure if I understand. Maybe one thing that when I am doing financial plans with people, and I think this is just a philosophy that I don't agree with, but my job is to do financial planning for people, and not to put my thoughts into what they want to do with their money and their life and their retirement. So around that, the way I interpret your question is, I get people who want me to do plans, not a lot of people. It's usually the opposite way. I get people that have a lot of money, they have a lot of tax problems, they have goals, they have estate goals, and they're trying to sort it out. And they've got corporations, and rental property is really messy, and they want me to help them sort that out. What you're talking about is people, I think, who say, I'm trying to have the lowest income possible, and so I qualify for GIS, guaranteed income supplement. And I've done a few plans for people like that. I just don't understand the merit of living on the least amount of income possible so you don't pay a lot of tax. I think they're so adverse of paying tax that they want to have the least amount of income. And to me, I'm working my butt off, just as I think many of you are, and I want to have a really good life. I want to buy experiences when I go into retirement. Like, I'm buying experiences now in between work. Like, you guys take vacation, I take vacation. I'm a human being too, but I'm buying those experiences as I'm living and working with my family, and balancing kids. I've got a son going to second year university. Our two daughters are engaged to be married. So, life is going to be busy for us over the next couple of years, and we're buying experiences. But when I go to retire, I want to travel. I want to see places. This globe is an amazing place with lots of amazing people and different things to see and experience. So I don't want the lowest income. I don't want to worry about paying the least amount of tax. I will pay the tax to buy the experience and to see smiles on my kids and my grandkids' faces. So I'll do plans for people if they want to drive the lowest income, but I don't agree with it. But nonetheless, I still do those plans. Lots of questions. Sorry. So there's one question here about lira. So is there a benefit to moving your lira to an existing RSP or keep them separate? Well, okay, great question, by the way. So you can't combine a lira into an RSP. A lira is pension money that came from an employer. So you were working for an employer, you had a contribution, so defined contribution, and there was your contribution and your employer's contribution. And so many times what happens is the employer's contribution comes out to you as a lira and your contribution comes to you as an RSP. You can't take your lira and then combine it to an RSP. They're two completely different products, and under the Pension Act, they're different as well. What you can do is you can break your lira. And when you break your lira, you can take that money, and once it's broken, you can take that money and deposit it to your RSP. So that's the only way to do that. And maybe that's what you meant by your question. Am I thinking, is that a good idea? You know, I don't think you need to do that. It's not. It depends on how much money you have, and whether or not, and the timing of when you want to take the money. You know, lira starts paying out at age 65 typically. So if you need money before then, maybe that's a reason why you want to break your lira. But I'm not in favor of doing that. I don't see the point. Maybe there is a small point, but I don't see the point of breaking your lira and combining it with your RSP. In fact, I'm even in more favor of you taking RSPs and having a couple accounts of RSPs. And let me explain this to you. When you RIF your RSP, you're RIFing the entire account that you have. So and this is before age 71. So any age before 71, you could have RIFed your RSP. At age 71, you have to RIF all of your RSPs. But you could just simply take one RSP and RIF that and start an income stream and leave the other ones alone. So I'm in favor of having a couple of different accounts. That kind of goes into the three bucket strategy on how to use your money in terms of how you divide your money up and which accounts and how those different accounts supply income streams. One supplies an income stream for you right now, today, this month, this year, and the other buckets are filling up the other buckets to supply the income stream that you need this year. So each of those different buckets have different goals, different return expectation, different risk profiles, so that you're not taking all your money that you need this year, this month, and having a risk tolerance that is on money that you're going to need 15 years from now. Those two portfolios should have entirely different risk profiles. The cash you need this month, the next 3 months, and 6 months have a much lower risk profile than the money you need 15 years from now. So I'm more in favor of, instead of you just thinking about combining accounts, of actually having different accounts with different risk profiles. Okay, so I think I've gone long enough. What do you think? That's an hour? If there are no other questions, I'm just going through this to make sure that there are no other questions. I didn't skip anybody, because I'm really thrilled with all the questions. This was an absolute delight to go ahead and start the live stream up with you tonight. It was really exciting to start the live stream. My intention now is to go every Wednesday if possible. I'll notify everybody when I go live ahead of time, so you know that I'm going to be speaking about a certain topic. You can always ask me questions during the live stream, even if I'm like talking about a different subject. I encourage you to please put your comments below on all these videos, because I love responding back to your comments. As you can see tonight, I'm answering your questions. I actually answer questions in the comments below each video. I get to each one of them, and I'll like them, or I'll comment to you. So you don't have to worry about that. I'll eventually get to your comment and write back, here's what I think you ought to do. And if there's a resource that I think you should explore, I just put that in the comment box saying, here, go to this website. There's a great article, great video about this particular subject. And if it's something that I think you ought to talk to me about, then I'll just put in the comment, like, let's get on a Zoom call or a phone call and we'll talk about it. So tonight's goal was to answer your questions and to also to really express my gratitude for this last 2 years of my channel. Having my channel get to over 10,000 subscribers is blowing my mind. I'm deeply grateful for all of your questions and your support. I love your criticism. If you have something to say about the video, that you like something and maybe it's a topic, I want to hear that you want more videos on this type of topic. If you want shorter videos, tell me you want shorter videos. Live stream is, I didn't care about the time. I would have talked for 2 hours if I thought there was enough people wanting to stick around for that. But tonight was all about you, and I thoroughly enjoyed seeing you today in this video. Tune in tomorrow morning, tomorrow morning at 10:45. I'm dropping another video. I hope you enjoy it, and I look forward to your comments. Again, thanks so much for showing up today's video. And I'll see you in all the other videos. Take care and be well. All right. Bye-bye.